What is trading? Simple explanation. Trading means buying and selling stocks or other financial instruments, like shares, bonds, mutual funds, etc., to make a profit. Imagine you buy a product at 100 rupees and sell it for 120 rupees. You make a profit of 20 rupees. In the stock market, you do the same. Buy a stock at a low price and sell it at a higher price. Types of trading. 1. Intraday trading: buy and sell the stock on the same day. Example: buy Reliance shares in the morning at 2,000 rupees, sell in the afternoon at 2,050 rupees. You make 50 rupees profit per share. 2. Swing trading. Hold the stock for a few days to weeks to catch short-term price swings. 3. Positional trading. Hold the stock for weeks to months, based on market trends or company performance. 4. Delivery trading, long-term investment. Buy and hold stocks for months or years. Good for wealth building, like investing in Infosys or TCS and holding for years. Why people trade? To earn short-term profits, to take advantage of market ups and downs, to grow money faster, but with higher risk. Important: trading is not gambling, but it requires knowledge of market trends, discipline and a clear strategy, risk management. Never invest more than you can afford to lose. What is option trading? Simple explanation. Option trading is like booking a right to buy or sell a stock in the future without actually owning it now. Think of it like booking a movie ticket. You pay 50 rupees to book a ticket for a movie. That costs 200 rupees, but you don't have to go if you don't want. If the movie becomes super popular and the ticket price rises to 500 rupees, you still get to watch it for 200 rupees. You got a good deal. If you change your mind, you can let it go and lose only 50 rupees. This is how options work. You buy the right to buy/sell a stock at a certain price on a certain date. You can either use the option if it's profitable, or let it expire if it's not worth it. 2 types of options. 1. Call option. You buy the right to buy a stock at a fixed price. You expect the stock price to go up. Example: you buy a call option for Reliance at 2,500 rupees, valid till next month. If Reliance goes to 2,800 rupees, you gain because you can buy it for 2,500 rupees. If Reliance falls to 2,400 rupees, you lose only the small premium you paid. 2nd, put option. You buy the right to sell a stock at a fixed price. You expect the stock price to go down. Example: you buy a put option for TCS at 3,500 rupees. If TCS drops to 3,200 rupees, you gain. If TCS rises to 3,700 rupees, you lose only the small premium. When to buy or sell a share, not options? To decide when to buy or sell your shares, look for these simple signals. Buy when. 1. The company is doing well, good profit, new products, expansion. 2. The market is rising, bullish trend. 3rd, stock price is lower than usual, but the company has strong future potential. Buy the dip. 4. Experts or research reports say it has long-term growth. Sell. When? 1. The company is in trouble, losses, scandals, weak leadership. 2. The market is falling continuously, bearish trend. 3. You've already made a good profit and want to lock in gains. 4. The stock is not performing for a long time or losing value. Where to observe these changes? 1. Price charts, up-down trends. 2nd, company news, on Money Control, Economic Times, or apps like Grow, Zerodha. 3rd, quarterly reports, profit loss. 4th, expert analysis and recommendations. Simple example. Let's say you're watching Infosys stock. Today's price, 1,300 rupees. You buy a call option at 1,350 rupees for next month. If Infosys goes to 1,500 rupees next month, you can buy at 1,350 rupees, gain 150 rupees per share. If Infosys goes down to 1,200 rupees, you don't use the option and only lose the small fee, premium, you paid. What is a candlestick in the share market? A candlestick is a special type of chart or symbol used in the share market to show how the price of a stock moved during a specific time, like 1 day, 1 hour, or 1 minute. It looks like a candle, with a body and sometimes wicks, shadows, on the top and bottom. What does a candlestick show? Each candlestick gives you 4 important prices of that time period. 1. Open, the price at the start of the time. 2. Close, the price at the end of the time. 3. High, the highest price during that time. 4. Low, the lowest price during that time. Green or white. Candlestick. Close greater than open. Price went up. The body of the candle is green or white. It shows bullish sentiment. Buyers are strong. Red or black. Candlestick. Open close. Price went down. The body of the candle is red or black. It shows bearish sentiment. Sellers are strong. How to read candlesticks to know market. Trend. If you see 1, many green candles in a row, market is going up, uptrend. 2, many red candles in a row, market is going down, downtrend. 3, small candles with short body, market is confused, not strong movement. 4, very long green candle, strong buying pressure. 5, very long red candle, strong selling pressure. Simple example, let's say you're watching Reliance stock. On Monday, open price equals 2,000 rupees, close price equals 2,100 rupees, high equals 2,150 rupees, low equals 1,950 rupees. Since close is greater than open, this is a green candlestick. It shows that buyers were strong and the price went up, so the market is bullish. On Tuesday, open equals 2,100 rupees, close equals 2,000 rupees. Now it becomes a red candle, bearish, price dropped. How to use candlestick for decision. If green candles are increasing, you can think of buying, market is rising. If red candles are forming continuously, you may sell or avoid buying, market is falling. Look at the size of candles and patterns. Big candles equals strong move.